Hi Raj. Before you start your business, there is one important question you will face. How will you take money out of your corporation?
I thought I'd just take money from the business account whenever I need it.
That is a very common misunderstanding. In corporate taxation, taking money out is called corporate distribution, and it must be done properly.
So what are my options?
You have three main options. You can pay yourself a salary. You can take dividends as a shareholder, or you can use a combination of both.
Why does it matter which one I choose?
Because it affects both your corporate tax return and your personal tax return. It also impacts retirement planning and cash flow.
So I cannot just randomly take money.
Exactly. If you do, CRA may treat it as unreported income or shareholder benefit.
Let us start with salary. That sounds simple.
Yes, salary means you treat yourself as an employee of your own company.
Even if I own 100% of the business.
Yes, ownership and employment are separate roles.
How does salary work?
The company pays you wages regularly. It deducts income tax. It deducts CPP contributions. It issues you a T4 slip at year-end.
What is the advantage?
Salary is a deductible expense. It reduces your corporate taxable income.
So the company pays less tax.
Exactly.
Okay, but how do I actually pay myself salary?
You must follow payroll rules just like any employer.
What are the steps?
First, register a payroll account with CRA. Second, add yourself as an employee. Third, calculate deductions like income tax and CPP. Fourth, remit those deductions to CRA. Fifth, issue a T4 slip at year-end.
When do I send money to CRA?
Usually by the 15th of the following month.
What happens if I miss it?
There can be penalties and interest because payroll deductions are considered trust funds.
Now tell me about dividends.
Dividends are payments you receive as a shareholder, not as an employee.
So I do not need to be on payroll.
Correct. Dividends are based on ownership of shares.
How are they different from salary?
Dividends are paid from after-tax corporate profits. They are not deductible for the corporation.
Do I pay CPP on dividends?
No, there are no CPP contributions on dividends.
That sounds easier.
It is administratively simpler, but not always better for tax planning.
How do I actually pay a dividend?
There is a process you must follow.
What are the steps?
First, decide the dividend amount. Second, allocate it based on share ownership. Third, pay the shareholders. Fourth, issue T5 slips. Fifth, record the dividend in the corporate minute book.
What if I skip documentation?
CRA may reclassify it as salary or a shareholder loan, which can cause tax issues.
So paperwork matters.
Very much.
I am still confused between salary and dividends from accounting side.
Think of it this way. Salary is an expense. Dividends are profit distribution.
Can you explain with an example?
If your company earns $100,000 and pays it as salary, corporate income becomes zero. If it pays dividends, the company first pays tax, then distributes the remaining amount.
So salary reduces corporate tax.
Yes, dividends do not reduce corporate tax.
That makes the choice important.
Exactly.
What if a shareholder lives outside Canada?
Then the rules change.
How?
For Canadian residents, no withholding tax applies. For non-residents, the corporation must withhold tax, usually 25%.
So they receive less money.
Yes, unless a tax treaty reduces the rate.
How is it reported?
Residents receive T5 slips. Non-residents receive NR4 slips.
So residency really matters.
It is very important in tax planning.
Is there any way to take money out without tax?
Yes, through paid-up capital, also called PUC.
What is that?
It is the money you originally invested into the corporation.
So I can take it back.
Yes, up to the amount you invested, tax-free.
Can you give an example?
If you invested $100,000, you can withdraw that amount without paying tax.
What happens after that?
Any additional withdrawals would be treated as dividends or other taxable amounts.
I heard about something called capital dividends. What is that?
It comes from the capital dividend account, or CDA.
What makes it special?
It allows corporations to pay tax-free dividends.
Where does the money come from?
From non-taxable portions of capital gains or life insurance proceeds.
Can you give an example?
If a corporation earns a $100,000 capital gain, only half is taxable. The other $50,000 goes to CDA and can be paid tax-free.
Is there any form required?
Yes, Form T-2054 must be filed to declare a capital dividend.
I see different types of dividends, eligible and ineligible. What is the difference?
It depends on how the corporation was taxed.
Explain that.
Income taxed at lower small business rates leads to ineligible dividends. Income taxed at higher general rates leads to eligible dividends.
Why does that matter?
Because it affects how much personal tax you pay.
Which one is better?
Eligible dividends usually have lower personal tax because corporate tax was already higher.
Can you give a real example?
Suppose your company earns $800,000.
Okay.
The first $500,000 is taxed at the small business rate. The remaining $300,000 is taxed at the general rate.
So what happens?
Dividends from the first portion are ineligible. Dividends from the second portion are eligible.
So the company tracks both types.
Yes, using different income pools for proper tax reporting.
Can I give dividends to my spouse or kids to save tax?
That used to be common, but now we have TOSI rules.
What do those rules do?
They prevent income splitting if the family member is not actively involved.
What happens if rules apply?
The income is taxed at the highest marginal tax rate.
So no tax savings.
Exactly.
Are there any exceptions to TOSI?
Yes, there are several.
Like what?
If the family member works in the business, if they own meaningful shares, if they contribute actively to operations.
Can you give an example?
If your spouse works full-time in your business, paying dividends may be allowed. If your child does nothing, TOSI will apply.
So involvement matters.
That is the key factor. Raj, once you understand salary, dividends, PUC, CDA, and TOSI, you can plan compensation properly.
I can see this is not just about taking money out.
Exactly. It is about tax planning, compliance, and long-term strategy.
Thanks, Alan. This makes things much clearer now.